With the auto sales number now, let's shift our focus to the interview of the day, of the morning. We are joined by the biggest banker of the country, CS Setty Chairman, State Bank of India, to give us an idea of Outlook 2025. Good morning, Mr. Setty. We really appreciate you giving time for us. And here's wishing at the outset a very happy new year to you and to everyone at State Bank and your family.
Good morning, Latha. Thanks for having me on the first day of the year on your show. And it's an honor. And I wish all the viewers of CNBC-TV18 a very happy new year. Along with your viewers, the whole customer universe of SBI, I wish all their families and their businesses a wonderful year ahead.
Well, 2024 was not an unkind year at all for State Bank of India. It was bad for the banking sector. Bank Nifty, I'm entirely talking from a market point of view. The Bank Nifty went up only 4%, whereas the Nifty went up 9%. But State Bank shares went up 24%. So it was an outstanding year for some of the banks. Mr. Setty, what went so right for SBI in 2024?
Apart from the market, of course, market has took some time to recognize the potential of the stock, obviously. What we have shown our resilience and the consistency in our performance, essentially. I think it is not only in terms of the largest amount of profit among the corporates in India. We also had focused on increasing our customer offerings, number one. Number two, we continue to invest in the technology and digital adoptions. And I think that also had contributed to our, recognizing the value what SBI brings to the fore. The other thing is, some of the conventional business lines, what SBI has been known for, we have strengthened our focus on them, particularly on the MSME, large value agriculture. And we continue to be market leader in home loans. And more importantly, above all, I think we have demonstrated the resilience in our asset quality. I think all these things have helped us to present a good picture to the market.
Okay. Well, that's good to hear. But, the big problem that bedeviled the banking sector, I mean, one of the reasons why perhaps the index itself underperformed is this desperate hunt for deposits and the rise in the costs. How do you see that panning out? Will the cost of deposits abate?
So, as I mentioned earlier also, Latha, in your show, that I think there's only so much we can compete on the interest rates. And we have to increase our customer services and in terms of value proposition, which the bank account brings, or bank deposit brings to the customers. I think more importantly, the post-COVID credit growth, which was substantially high, and the deposits have not kept pace, probably had created this imbalance. If you see the November numbers, I think broadly, both the deposits and advances are coming to some equilibrium. So the renewed focus on the deposit mobilization by the banks and the balanced growth in advances, I think is helping us to set the balance in place. So I don't think there will be too much cost escalation on the deposits. Obviously, all the banks are focusing on activating their networks, branch networks, and also redesigning the products and processes. How do we retain and mobilize more deposits?
Okay. So you think this? I think even SBI offered one 8% product for a 1 year, FD. Is that the peak?
No, I don't think we have offered 8%, but it is our highest rate of Amrita Vrishti is around 7.25%.
Okay.
So with some additional interest rate for the senior citizens.
Yes.
But I think I personally believe that the interest rates on the deposits have picked.
Okay, that's good to hear from a bank investor point of view, even if it's not very good news for pensioners. But how do you see credit growth picking up? That was the other issue. Credit growth had to be brought down below deposit growth, or at least to deposit growth. Where are you seeing credit demand? Are you seeing industries, corporates hungry for credit at all?
Corporate credit growth essentially is coming from some of the sectors. Obviously, the renewables, roads, some of the petrochemical expansion has also contributed to the credit growth. But I think core sectors, the capital expansion has not been happening, particularly in the steel, cement. I think there's a more of consolidation which has been happening there. Hopefully, one important thing what we noticed is the housing sector is doing well, which means that some of these sectors like steel, cement probably would do better in the current calendar year.
Okay.
As far as renewables is concerned, I think as you have shown in your show also, that the renewables is coming across solar, hydro, pumped hydro, for instance. I think a lot of capacity additions is happening on the renewables. And the green financing probably would be more focused in the current calendar year.
Okay. So for 25, what kind of a credit growth, or even FY26, what kind of credit growth, what kind of margins, ballpark ranges?
Margins, I think, broadly would stabilize because, as I said, interest rates on the deposits have peaked. And we need to watch out on the policy rates also, how interest rates movement is going to be, behaving in the current financial year and, of course, current calendar year. My view is that I think rate cuts would be there, which means that the softening of interest rates will be there, which would spur the demand, particularly on the retail side, which was some kind of, other than housing, the other segments of retail personal was slightly slowing down. And the interest rate reduction would definitely spur the retail credit growth. As far as the corporate is concerned, the capacity utilizations are at the peak now. I think most of the sectors have reached 75% capacity utilizations. But I think external sector is making them to hold back a little on the capital expenditure. So if some clarity emerges on the external environment, I think they all will come back to the capital expansion.
Yeah, I take your point. Quite a few CEOs were saying that uncertainty over trades, tariffs, exports is leading to perhaps postponement of decisions. But let me come to the micro challenges, or rather specific challenges to the banking sector. One, do you think fee income is under threat? I mean, you all made a lot of fee income because of selling insurance. Now both the insurance regulator and the banking regulator are moving to curb that. Will that be a dampener for the entire sector?
Fee income, particularly which comes from the
sale of insurance.
Cross-selling is not very significant. If you see large banks, our fee income is minuscule from coming from the cross-selling part. I'm sure, I think most of the large banks also have a lot of other income streams other than cross-selling, which is available to us. Particularly, we have bulk of income coming from the forex and treasury activities, and also from the loan processing charges. I think these other income streams will continue.
Okay. All right. I think the problem is more for SBI Life, or perhaps for all the life companies, if their parent companies are curbed from selling too much of their products. It's not your problem, it is the insurance companies' problems, right?
No, most of these insurance companies are also diversifying the way they source their business. Obviously, the agency channel is picking up across the industry. Obviously, in the initial stages, the dependence on banker will be there, but I'm sure, I think all these companies will find different ways of doing the business.
Okay. Well, there are three big overhangs on the banking sector from the regulator. One would be LCR, the other would be the project finance higher provisioning, and the LDR provisions as well. Expected loss provisions as well. Do you think FY26 will see the brunt of all these, or will they be more diluted than we think?
So we've been engaged with the regulator through various fora, especially through the IBA. We have given our views on all these three areas where the discussion papers and draft guidelines were issued. And I'm sure the regulator will relook into, some of the suggestions what we have given. So we'll have to wait. I have no view on what is the timing and in what form it is going to come in.
We will reserve that question.
But
We'll reserve that question.
I think the regulator would definitely consider many of the suggestions what we have given.
Okay. No, I agree with you. I'll reserve the question for the RBI governor if and when we get him. Just a final word on this unsecured loans. Both the financial stability report and the previous trends and progress in banking kept saying that they're worried about unsecured loans. Although GNPAs are at all-time, at 13-year lows, do you think this unsecured loan is going to give NPAs even for SBI?
If you ask me, from SBI side, we always said that our unsecured loan portfolio is completely different. In fact, we keep saying that our unsecured loan portfolio is more secure than anything. So I don't see any asset quality issues. Of course, it's not appropriate for me to talk much about that on the SBI numbers. Our silent period kicked in. But one definite development in the market is that with various measures, what RBI has taken, there is a moderation in terms of the growth of unsecured personal loans, as well as the way the unsecured personal loans are being underwritten, priced, monitored. I think there's a huge amount of work which had gone into it. So obviously, I think that would result in the better asset quality going forward.
All right. We leave it at that, sir. Thank you very much. You give us some optimism that for the banking sector, deposit costs have peaked and therefore margins, if anything, will stabilize, and you are seeing signs of credit growth. Thank you very much indeed for joining us.
Thank you, Latha.